So we offer lots of classes and good stuff. You'll get these slides after the session. You'll also get a recording of the session afterwards as well. If you want to check into anything, if you heard some great questions, or if you want to review some comments that some folks provided. All right, Paul, we got you. We got Mark in Denver, Gusty. We got Paul out there in Palm Beach, Florida, Palm Beach County. God bless. That's awesome. So yeah, so you'll be able to review the chat and some of the other conversations that were going on. So we're going to jump into this thing, and we're talking about Lean Portfolio Management Primer. And as you can see, first and foremost, feedback is critical. Not feedback as in, oh, this is so great. Feedback as in, hey, I don't agree with this, or hey, can you dig into this point more? Or here's some of my thoughts on that topic. You know, the best learning happens when we kind of push each other a little bit, when we challenge each other respectfully, when we share ideas and thoughts and opinions. Please don't hesitate to do that. Please don't hesitate to share materials that you might have read that you think are really valuable, any additional thoughts you may have on this subject, any particular practices that you utilize that work well for you. You know, this is a tough topic. It's not easy. It's only going to get harder and harder. So please do not hesitate to share your thoughts and ideas and questions. I'll take them throughout the process. Any and all questions you want to present, shoot them out there. I'll do my best to answer if I can. If I can't, follow up with you and I can grab an answer, and maybe there's somebody out there in the audience who can answer. Now, I can also let you talk. So if you want to raise your hand and you want to say something, there's the group is small enough that I can certainly allow for anybody to share their thoughts or ideas as well. So we're going to talk about why first off. We're going to talk about why, and we're going to talk about what. We are seeing your slide deck, but not the slideshow. Oh, thank you, Dwayne. I forgot about that. Let me do this. Watch. I got to do something magical. There's a security alert. What's up with that? Don't know what that is. But there you go. Magically working now, Dwayne. Thank you very much. So I got through all my babble. Let's get into this thing. We're going to talk about what is LPN and why should we be using it. So folks here, you folks should be most likely in the project world. Some of you are agilists, some of you aren't. Most of you have responsibilities to think like with a product mindset. Most of you have responsibilities to look at things through the lens of the product mindset. Some of you might actually be working on external products. Most of you are probably working on internal products. So when we talk about lean portfolio management, what we're getting at is how do you deal with all the stuff you have to get done? How do you think about all that stuff? How do you categorize all that stuff? How do you start the process of deciding what should get done and why? It's one thing when you run an agile team where you can make decisions about how you should be doing things within the context of that work structure, of the stuff that you're working on and the time boxes that you're within, and ultimately the releases you're trying to work on. It's a whole nother thing when you're looking at that from a couple other steps higher. Now the thing for me is that I've been doing this really since I was a product director right around 1998, 99. Internally, I was doing a lot of it when I was running the Canadian operation for Global Knowledge, then did a ton of it when I was running my own training company. But from an external perspective, my gosh, I've been doing lean portfolio management most of my career. Now, let me throw a couple things at you. Most of you, if you have a 401k, have been doing portfolio management. You're managing a portfolio of financial products. And some of you probably have quite the meaty 401k and quite a might even have quite a sophisticated process for managing that portfolio. So remember, in the 401k, that portfolio is a bunch of different assets at different asset classes. So we're not looking at specifically drilling down into that one specific asset, or as we are looking at the total package and saying what direction do you want to take that total package in. So why is this thing so important? And now you can hear about VUCA all day long. And this slide kind of represents it a little bit goofy because it's a little bit out of order as it relates to VUCA: volatility, uncertainty, complexity, and ambiguity. But the reality is, as someone who's driving business, you really have to be looking at your overall portfolio through this lens, because you can't get myopically focused on one thing, or you're going to get hit in the face by a train. So what we want to talk about first is, okay, how does this VUCA thing relate to portfolio management? Well, the VUCA thing relates to portfolio management because you're dealing now with a lot less understanding of how things are going to look. We got that ambiguity thing down there. So some people call them the unknown unknowns. You just don't know. You just don't know. And we're kind of used to working in a lot more certainty. So you have this understanding that because you don't know, you're uncertain how those unknown unknowns are going to come out, what you should be doing about them. So part of the lean portfolio mindset is the word lean. We're looking at trying to keep it light. We're trying to keep it value driven. We're trying to keep it nimble and flexible, because when you look at things in a VUCA world, what you realize is you have to attack a VUCA world in bits and bytes. That's how you protect yourself from that volatility, is you're attacking in bits and bytes. And now we know this from the agile mindset, and the agile mindset attacking things in bits and bytes at the project level is really good, because you're just looking for change within that sphere of that stuff you're working on. This, you're taking it up a notch. So you really have to have control and certain mindsets around how you're attacking some of these changes. And so folks are going to use not technologies, but frameworks like lean startup, like design thinking. Service design is another framework that you can start looking at, searching for these unknown unknowns. But as a portfolio leader, what are the tools that you're going to use to ensure that a part of your portfolio, in terms of both money and time, are utilized searching and thinking and researching? And that's not just for potential new things. That's also for updates to current things, because when you live in a high level of ambiguity and uncertainty, you can't predict. As the book The Black Swan talked about, you have to look into the future using the marketplace as your guiding force. And as an adaptive leader, we'll talk about, you also want to be able to hold steady based on some of the information you got, to let things percolate a little bit more. Even though the world is moving very fast, it's not going to instantaneously take hold of something you're working on. It takes time for things to permeate in a system, unless it's something really bad, because bad things flow through a company like a rabbit, and good things flow through a company like a turtle. But ultimately, you've got to give things time to gestate, to digest, whatever word you want to use for it. So what you have to do at VUCA as an LPM is you have to believe it. You got to say, I do believe that VUCA is there. Okay, once you believe it, you got to understand it. And the base understanding of VUCA is you just don't know. You need techniques to know, and the best way to know is into the market. Into the market, whether it's an internal market, whether it's an external market, or even if you can create some type of AI-driven market. I mean, much like the cloud folks do with their container solutions now, maybe there's a chance for us to create an AI-driven marketplace with personas and watch the impact of certain changes at the second and third level that we would only really be able to see in a true test production environment. You never know. But that tool could be very, very powerful if we could have it. So we're going to attack lean portfolio management. We're walking into this with a business agility mindset. We're walking into it with an idea of change and response, that ultimately looking at value delivery and then working through the teams that we have. That's a lot of business speak. What I like to say is I have to get things out there in such a way that I don't kill my company's coffers or people to get it out there to test and to see how many of those things I can have testing based on how I want my portfolio to look like. I'll give you a great example of this as it relates to my business here at SoftEd. My portfolio is pretty extensive. We have 40, 50, 60 different classes. Can actually have more when we count our partners out. So I have a goal, and that goal at company metric is 60 points of margin. So margin is the revenue you have after the applicable costs associated with delivering that revenue. So I have to reach a certain number, and that's that 60 number. If I'm not managing my portfolio right, then all I'm doing is saying I just got to find things that make that 60 number, or else I can't operate. So I'm basically trying to build things to hit a number. So what I'm looking at my lean portfolio management is I'm understanding there's all different attributes of the things that I do. Some are great margin, some are poor margin. But if I have something that could be great margin that doesn't sell, then it doesn't get to my goal because you have no margin if you don't sell anything. Remember that. You have no margin if you don't sell anything. So as a portfolio manager, I'm looking at all running the things I know that will work in such a mix of effort and time that so in aggregate, I reach that number. And this was a tough thing to teach the company I'm currently at initially, because they really didn't understand that mindset. Initially, they were just like, we have to build this for this. I'm like, look at, you have all these different things. You see the different margins they deliver. All right. How do you manage that as a portfolio to get to where you want? Because, you just don't know what's going to work. And so if you end up with a client that's working really well at the lower margin side, then I'm going to have to figure out, okay, what else I can stick in there and how I can stick it in there. And that goes back to my prioritization techniques. And what am I going to prioritize as relates to time, energy, and effort to make up that miss from a margin perspective, as I was talking about. So, whether you're internal or external, you do have to kind of think about who you're going to be. Who are you going to be? What approach are you going to take? And so you're going to laugh at this. Most of you don't know who this is, but Golden Corral is an amazing, people are going to laugh already, I see it as an amazing buffet restaurant. Food galore, just everywhere that I can see. Lots of great choices, unlimited capabilities of eating. All right. Not the healthiest thing in the world, but I know everywhere I go from a Golden Corral perspective, I know what I'm getting, and I got choice. So when I ran my training company, ASPE, I wanted to kind of be that Golden Corral. I knew you're going to get, it's going to be good, and I'm going to price it in a place that makes sense. Because I needed to have some scale. And I needed to get into that marketplace and fight it out because it's such a competitive marketplace. So each one of these folks have a strategy. So as you're looking at your internal resources, you're going to have different strategic approaches. You may have a need for a very specific CRM with customization that would make you kind of be differentiated in a niche product because of your difference. So I have to have a product that is high end, lots of bells and whistles. I have a sophisticated sales team and a sophisticated sales process. Then there's going to be other organizations that say, look, just strap in the out of the pocket, Salesforce thing. I got a bunch of different salespeople. They're all going to use it basically the same way. Plain Jane, vanilla, get it done, easy to start up, lots of turnover. So I got lots of turnover. I got lots of salespeople. I need to be able to turn on and turn off very quickly. I just have a box of things I want to do. Let's go turn it on. And now we're looking at, narrow market, lower cost, or really broader market, lower cost too. Now, I would say that would be more narrow market because that's just the sales team. But you get the drift here. You can see this in your head. So you have this overall approach you're looking at, but the problem is you just don't want to be just one of these, because inside of your organization specifically, you have probably each one of these markets going on. So where do you have a very broad market solution that has to look like a consistent Walmart or Amazon? Or where do you have something that really it's broad, but needs to have some bells and whistles associated with it, some customization, some feature functionality? And then below you have the goal. Maybe there's some reporting that has to happen at the executive level that really needs to be, state of the art. Or maybe you have something that the compliance side that has to work perfectly. And then finally, you might have those nichier, low-cost items. Because people have a tendency to go after just one trend. I'm only going to do this. And so they do that for everything. So you really have to fight your mindset to understand who you're working with and why are you working with them. So you see brands here. Remember, this is external. From my perspective, internally, there may be needs to do all four of these strategies depending on the audience and the needs of the audience. Now, externally speaking, the reality is that you do have to watch out for getting into this brand basket in VUCA. Starbucks is getting hit on multiple sides, for the McDonald's of the world, to the Circle K's of the world, to the Dunkin' Donuts of the world, so they'll probably start trying to change and adjust a little bit. They might even start falling down to more of the Rolex Tesla model at some point because, they've been myopically focused on that one, differentiated, but at a broad market perspective. I mean, you could take this slide and you could talk about things all day long. But one of the things I tried to do externally was have a multiple brand, sub-brand approach. So each sub-brand could look a little different than the major brand because the major brand had different type of buyers than the sub-brand did. So when you look at training, you have a finance buyer, someone in accounting and procurement, you have a learning and development buyer, and then you have you folks, managers and people that do the work, the managers who manage the work and the people who do the work. So each one wants to see things a little bit differently. So I took a very sub-brand approach so that I could articulate the offering to that persona better. So part of this portfolio management isn't just how you build it, it's also how you communicate it. And this is one of the things I think that specifically internal organizations are missing. Internal software project groups or project groups are missing a stronger internal marketing system to communicate what's going on and why is it going on. What's going on and why is it going on? Because especially when you're doing some of that transformational things that you can see in this mixed slide, if you're doing some of those transformational things, education is going to be very important. If you go back to the top, if you're doing a Rolex, if you're doing a Rolex type deployment in a certain group, education is still important. One of the things is you want to talk about how much you're spending for them to use this, which is going to increase their sense of obligation to use it. But we don't even talk about that in a lot of cases. So if you're taking that next step and you've got some sway in your PMO or your VMO, value management office, talking about that internal communications process, what type of position is going to do that? How are they going to do that now that you have AI available and the video things you can do with AI, the image things you can do with AI? There's some very powerful communication tools you can utilize to help spread the message about your portfolio and the different elements of your portfolio more successfully. No questions yet. I'm a little surprised. Comments, thoughts, ideas. don't hesitate to share them at all. If you're going to ask me what soft dead looks like in that top slide, I'm probably not going to tell you because they'll get mad at me based on my perspective. But I do have my vision of who we are from a U.S. standpoint. So going back to the financial 401k scenario, a lot of our 401ks look like this. You're going to have 30% bonds, 70% stocks when you're younger. You're going to have 50% bond, 50% stock when you're older. Within the bond side, you're going to have municipal bonds. You're going to have some more risky bonds. In the the stock side, you're going to have small cap, mid cap, large cap, growth versus value. You have your small cap growth. That's going to be your transformational stuff. Some of your mid cap values might have some level of core associated with them. So that's what your financial planner is doing, or you might be doing this yourself in your portfolio model. The same token goes for your corporate model. You have things that run the business day in and day out. So we have a tool called Arlo. Arlo is our registration database. It's old as mud. But the reality is there has always been so many other battles that needed to be fought from a portfolio standpoint that actually has been managed, from my perspective, somewhat correctly, saying that this is it. It's in the box. We have lots of other things to work on that are customer facing, that are generating value. So we keep the core in the box. There's not as much money placed there. There's not as much time placed there. And it is what it is. So now you're going to start seeing your metrics management associated with this. Then you have other things that, that need some help. That you might have to add a little bit here, a little bit there. It's usually existing that might be being impacted more by VUCA. You might be seeing trends in the marketplace that are telling you this. Your internal clients are talking to you about this. So, how are you going to manage your resources and time there? It's easier from an external perspective. It's so much easier to get money from an existing customer than it is to bring in a new customer. But on the transformational level, when you hit, 60 to 70% of your margins can come from your transformational product. So in some cases, 60% of your increase in efficiency within organizations can occur at that transformational level. The transformational level, of course, is scary. It's scary because there's so many unknown unknowns. But the first thing is have you documented, your portfolio in such a way? Have you even thought about it this way? This is the thing. One of the most important things with any type of portfolio management solution or mindset is you first got to be thinking, I have a portfolio. Since I have a portfolio, how am I going to put that portfolio into some type of box? For me, I have my old classes. I have my mid-level classes that might get touched by VUCA, might need to adjust, pivot, and I have all these new ideas I want to bring out. So I have lots of testing mechanisms to bring out those new ideas. One of the biggest testing mechanisms we use, you're sitting through right now, a web seminar. A web seminar is a testing mechanism for us to look at different topics and ideas to see what the marketplace's interest is and thoughts associated with it. Oh, Trent, you put something in the Q&A. Great. Next time, if you can put it in chat better, I'd watch that more often. And so Trent talks about, is there a good rule of thumb for what percentage of the resources split between run the business, do business, and R&D? Trent, this is the problem. There really isn't, because you also overlaying this with margin requirements, with revenue requirements. What I can say to you is this. The more volatile your marketplace is, the more time and effort needs to be spent on R&D. What you want to do is you want to get your run the business as automated as possible with as little impact as possible. Now, that's what's going on the non-generative AI side. That's really what's going on with GE and its smart machine technologies, is trying to make the machines that run the operations so smart that they schedule the service. They can self-heal if they need to self-heal, so that the stuff running doesn't necessarily have to be touched, and you can start thinking about what else you can be doing with the stuff that's running. But it all boils down to that time. That time piece is so important, because if you have a self-healing machine, okay, what are you going to do with the time that's now available? Are you going to change the staff? Are you going to hire certain people? Are you going to be doing more testing? So I would tell you that I would test 3 new products a month at the one company I was at a go-to-market strategy that was based on prototype. I would market prototypes. So those 3 classes probably represented about 10 to 8% of the things I was running that month. So I was fixated, and I am still fixated on new and R&D a lot. If I ran another business in my industry right now, I'd be probably spending 40%, 50% of my time on R&D once I found a stable product. So with you folks internally, what you want to be doing is making the basic operation of CRM work, but always be thinking about what else you could do with it. So Dwayne says, what horizon investment planning come into play for the allocation question? Dwayne, large companies get a little bit more sophisticated on this than smaller companies do, but you got to first, if I'm in a small company perspective, I'm thinking about 2 things. Am I a lifestyle business, or am I an equity event business? If I'm an equity event business, my horizon of investment is going to be more aggressive, because I'm trying to get more rapid growth, and I can stay away from not having to really meet a profit expectation, so I can go after rapid growth, so I can spend some more of my profit on trying to test new things. If I'm a lifestyle business, I'm going to focus more on stability of running that core business to the maximum possible efficiency I can, and not worry about as much about the hills and valleys that are going to hit me, because I want to maximize profit in the near term. But the same token goes for big companies. Big companies are going to have different mindsets around revenue versus profit. They're going to have ideas associated with what direction you might want to go into and why. The downside for bigger companies is also you have the issue associated with stock buyback. That's on top of this idea: do I want to make revenue, or do I want to make profit? When you're making the stock buyback, you're still absorbing cash, but you're forcing the company to try to do both revenue and profit, but you're absorbing cash in, so you don't have that money to invest. It may look like you do, but you don't, because you're just using that money to buy back your stock, to increase your stock price to meet investor expectations. So when you say would Horizon, I guess what you're saying is, would Horizon investment planning come into play for the allocation question? Yeah, you're going to be looking at where am I trying to go, and when am I trying to get there? Especially from a financial standpoint, I talked about this with what age are you at? But I'll tell you what, on the Horizon side, Dwayne, I've seen more and more people not following that and just being aggressive constantly. Whether it's for a corporate portfolio internal, corporate portfolio external, or your own personal finances. It's kind of an interesting scenario there that people are thinking about. Keeping payment from new ops versus keeping the lights on. Yeah, part of what we're talking about there would be, I talk about the fact that the more you can automate the keeping the lights on, the more time you can spend testing for the opportunities that you need to get your hands on. And going back to the whole VUCA concept, companies on the S&P 500 used to last 60 years on the S&P 500. Companies now are lasting 15 years, 13 years on the S&P 500, because they spend way too much money and effort on the things that they're currently doing, and they use backloaded data to plan front-loaded opportunities. This is the other problem that we have with portfolio management, is that there's so much fixation in the corporate environment to manage based on back data, information that you got based on what you have done previously. So that just mindset alone is going to keep you fixated on trying to tinker and work with that which is at the core. Yes, exactly, Dwayne. So what happens with LPM is lean portfolio management professionals have to get better at communicating ideas like opportunity cost, time, what have you lost in time associated with not being able to go after certain value elements, measuring the impact of a new product into the marketplace. And it's going to take a little bit of time because it really hasn't happened in the number of years I have been in business, but to try to be able to quantify that can help give you some forward-looking data that could help establish a better mindset around testing for the future. Instead of having 80% of your budget and time focused on making things work that is currently there, because that's where the money's made, maybe trying to figure out a way to split that better based on the cost of the opportunities. So really, really, really good point. And this is a hard thing to do when you don't have control either. Remember? So like if I am an executive within a company, the reality is I should be operating on lean portfolio management mindsets the entire time I'm working. If I am a director at the director level, I got to find the places that I can influence and the ways that I can bring stories and outside information and certain data to the table. One of the things I talk about a lot these days is comps. Houses, you're going to sell your house, you're going to look for comps, comparables. As you're looking at entering new marketplaces, being able to judge things against comparables is a great way to set a mindset. Maybe teaching your organization more about valuation, being able to say, here, we're going to start out in this area. Here's a couple startups in that area. Here's their valuations for the services that they're offering. This is what I think this thing could prove out if we can get it running. This is the value that could be generated from that product or that external solution. So we've got Mark says, David, can I suggest if questions are sent, panelists use the everyone setting in chat so we can see the dialogue? I don't think everyone is seeing any of the questions you are addressing. You only missed one question so far, Mark, and that was from Trent. He did that in the QA space. All the rest of the questions so far have been coming into chat, and I'm making sure that everyone can see, and I'm making sure that everyone can address. So I double checked that. Great question though, Mark. I appreciate that. So, when I looked at these three models and having this conversation with you, each one, is relatively, in some cases, the same. You're all, you're kind of slicing hairs, but, let me go ahead and switch here for a second. So I'm going to stop sharing here. And I'm going to bring on another share. Let's see where that share is going to be. Oh, so you should be seeing my screen right now. And on my screen, you should be seeing understanding the Boston Consulting Group growth share matrix. Do you see that? So you can chat in and let me know. I greatly appreciate it. Should be seeing understanding the Boston Consulting Group growth matrix. Great, Bonnie, thanks. So the growth matrix is definitely more externally focused, but it's going back to the same slide I showed before. All right. What are the things that are just there? Dogs. A dog with fleas, as it comes from, if you ever watch Wall Street, the old 1980s, Gordon Gekko show. These things are just there. What are those things? So at least you know what those things are. What are your cash cows? Those things that you do that make you money. In most businesses, 20% of the function that you got produces 80% of the return. So externally thinking, 20% of your product makes up 80% of your profit. Internally thinking, 20% of your systems make up 80% of the productivity enhancements and the value that's created in the marketplace. So where is that 20%? And the better you can categorize, the other elements, those 80% into dogs, then you can actually allocate money and time better. But as we were talking about, we have to talk people into believing that and not just using backloaded data. So you have your stars, and your idea is, okay, what is going to hit? What's going to hit? And we got opportunity there. We got a marketplace. We have opportunity there. So I'm going to give you a big pitch here for me. AI is, to me, very similar to what the internet was back in 2000, really 1996, 97, or what e-commerce was in 2002, 2003. So we have a bunch of project managers in our database. We're combining generative AI and project managers, generative AI and business analysts to come up with a new market star. And so far, it's showing a lot of potential. And look, that wouldn't happen unless there was change. Then next is the question marks. The question marks is, there's a really big opportunity, but I don't know what I don't know. So this is a really good external model to be thinking about as you're laying it out. And so the real challenge is, here's the biggest challenge for portfolio managers. Question marks. I mean, if you don't lay that case out, it's a no-brainer. No. Why are we going to waste our time there? We have to be focused. The cost, the opportunity cost of not doing it, the reduced amount of value. We'll get to that in just a second. So purpose. Purpose was really interesting. Purpose-based alignment, right? So this is kind of internal. It could be used from an internal standpoint in a lot of cases. Differentiation is when you have you have the people are inside your company are using it. Then you want to keep them using it because we know it produces value. So how are we going to update to keep aggressive? This has to do with websites and insurance companies. They fight constantly to provide internal products to external customers that can utilize to give you that one little different step in the competition. Was it one of the car companies is offering the fact you can set your own price before you have to take the credit hit for a car. That's a new technology that they're rolling out with some differences. Then the parity side is we just have to keep it going because this is an expectation. Really, the reality is you start looking at some of these internal systems, it's going to be a difference between someone takes a job with you and someone doesn't take a job with you. If I'm going after a high-end salesperson, I'm going to pitch them on the Salesforce deployment we have, the sophistication that we have, the connectors into other systems that we have, the data outputs we can have, so that differentiation of that internal product is going to help you get better resources. So there's another part of the value equation you can go for. Internally, you have to think through the people that are using it and what can you do to ensure those people can be better. And one of the things is you can bring better people in if you have differentiated services at certain parts of the organization. And the thing about this next scenario, this is problematic because two things happen on this left side. One is somebody somewhere is going to care because it's owned. It's called the endowment effect. The endowment effect says that if I own something, it's valuable, whether it's valuable or not. So it's tough internally to do who cares when people are operating it. How do you pivot that mindset? And the reality is the more who cares can be automated, the better. And that's got to continue. Because you want to get the goal for portfolio managers is to get more time to test, to bring out differentiation, or more time to partner to test out new potential ideas through partners than it is to manage the who cares. So one of the things you're doing as you're laying your stuff out, here's all the who cares, folks. Here's all the money we're spending on the who cares. Does this make sense to you? Meanwhile, we're losing market share here, here, and here. How are we going to make that adjustment? And market share could be utilization. Market share could be productivity of the resources within the organization. Maybe there is a metric that says, at this size company, a really efficiently operated accounting group only has 50 employees. because we're using this type of technology. And you look at your organization and you're using, you have 100 accounts. Okay, what's going on? Where you're not keeping up with the technology in order to drive better utilization. I'm a big partner fan. I'm a big partner fan to go in when that Boston Consulting Group question side. When I'm in that question side of going after when I'm going after a new marketplace with something that seems hot, that's where you partner. You convert a fixed to a variable. How can you bring something in and you can test that capability before you want to decide to scale? Portfolio managers should understand the make, buy, or partner mindset. That should become second nature in their mindsets. And then finally, this is very good for, looking at incremental, weighted shortest job first. So the idea is, okay, I got to do something. All right, what's the smallest increment that give me the highest amount of value? And that's tied to, my gosh, if we don't do this, this is what we're going to lose. So a lot of you see this model with the idea of snowball effect for the financial planning world with, gosh, I forgot his name. Folks, if you remember his name off the top of your head, bald guy, talks about financial planning. Snowballing is you start with the smallest stuff first, higher interest rates, you knock those things out, then you go bigger and bigger and you create the snowfall. It's psychologically oriented, as well as, it's a good way to cut down your portfolio management. Dave Ramsey, thank you, Mark. So he follows a lot of the cost of delay divided by duration mindset, but he doesn't just do it from a financial standpoint as it relates to interest rate. He also does it from a psychological standpoint, because getting something out and in the world functioning. I did this at SoftEd by starting out with conferences on generative AI. I knew I had to get something out there, not just web seminars, not just LinkedIn live sessions. I knew I had to get something out there. So I went ahead and did a cost of delay divided by duration. And I went after a full day conference, a little bit higher price point than I probably should have went out with, but was able to justify that revenue could be made here. I couldn't just do it for free, because that's not going to correlate to the stuff that we make money on, which we make money on training classes. It's just going to be seen as another free webinar, another free LinkedIn Live. But I had to get something out there that would have an impact to continue to generate the buzz internally to keep the spigot open for partnering on the additional generative AI classes that we are now bringing to market. Well, anyways, those models are three of the models that you could look at as it relates to how you might want to put things down and think about things. The big thing I continue to try to reinforce in this is, number one, you got to know what your stuff is and where it's at in its life cycle, and be very honest about it. Really looking at it through the lens of generation of value. Does it make money? Does it produce productivity and does it increase people's work rates? Then number two is you have to understand what's going on inside of the world you work in and have a plan to look at those question marks and those stars. Tied to that, better metrics around showcasing the amount of loss and value productivity that happens when you don't do anything. Because what you're trying to do, let's see, weighted shortest for equals economy sequencing, which is opposite of HIPPO principles. Thank you, Dwayne. So basically, what we want is we want to be able to show why things need to be tested, fight against backward data associated with financial decisions around what should be done and why, and to be able to become strong at testing those things that are question marks or stars either externally or internally, to get as much of a quick impact as possible to build the snowball effect, to get the energy going. So as I'm looking at my portfolios, I'm thinking, how are we ensuring we're doing the right things? How do we make sure that it's economically sound? Because doing the right thing may not produce the economics that you want to produce. And then, can you do what it is that you're trying to do? So this is product management 101. The idea that, are you creating value? And the value creating, can you provide a return? And then, can you deliver on that value? Is it possible to even do what it is that you're looking to do? So as you're testing out those question marks and those stars, where are they at here? And then how far off the reservation do you have to go to try to get something to happen? I had to go so far off the reservation, but I thought it was important they had to partner for an e-commerce system to do the conferences. It took effort. It didn't cost money, but I couldn't get access to Arc e-commerce because of the cost of unit sale. So I had to partner with someone else to be able to show the viability of this potential star product. I mean, it sounds crazy, but I made a decision based on the marketplace to go ahead and show that possibility. So ultimately, you have to be out there looking. Product managers are great questioners. They're great observers. They're great researchers. They're great. They are very curious. You want to be able to explore, either using technology or using your own time and effort, to go across, multiple parts of an internal system or multiple parts of an external opportunity to really see where your pathway to success is going to be. Because in VUCA, you want to be able to have the capability to adjust quickly and pivot quickly and turn things off quickly. And the concept of portfolio in and of itself doesn't, that connotation isn't there. Portfolio large, titanic, tough to turn, slow to respond to change. But if you can show the portfolio in some of the quadrants we're talking about, or some of the models we're talking about, then you can show the areas of the portfolio that is changing, that need to be explored, and doesn't necessarily need to have a fixed budget or a fixed plan as part of that exploration. So lean portfolio managers have to be really good at being able to go do instead of being told, being able to operate independently, being able to bring in lots of disparate information, being able to communicate appropriately and consistently, as I was talking about with maybe some of the video and some of the imagery AI, generative AI tools that are out there for us. But what's missing here is the ability to create the work. There is no prescribed plan when you're driving a portfolio. You got these models you can talk about. You got different metrics that you can follow, but there is not a roadmap. You have to create the roadmap and direction and where things are going and why they are going there, which means you have to be in motion, allocating your time accordingly, with some primary objectives as your fixation. For me, my primary objective is revenue growth. I am fixated on growing revenue. So I am managing my time and my portfolio and effort around those things that can grow revenue, and doing my best to do as little as possible with the things that are status quo. Because in my business, if it's status quo, it's not changing, then it could be taught consistently with little to no additional effort in the way of sales or marketing. Where most, if not all, of the energy on the sales and marketing side has to come from the innovation side of things, the question mark side of things, or the star side of things. And we'll finalize with metrics. There's so many different metrics we can look at, and so many different ways to provide governance around that. When I owned the company, the primary metric for me I watched closely was 39%. When my marketing cost and my sales cost as a percentage of revenue got above, sorry, not 39, 29. When my marketing costs and sales costs as a percentage of revenue got above 29, I was in a big, massive problem. So it was one of the first metrics I looked at. Then, as I started having to make adjustments, I would look at the portfolio. And as you saw, my portfolio was wild. Some products had the marketing cost of 5%, some had 10%, some of the newer products had 40%. So I had my metrics based on understanding I had to upload marketing to the newer stuff, which sounds completely oxymoronic. But the reality is new things need to be worked at first and communicated first hard so that it can become a consistent player. And then ultimately it will grow into less investment. So that's the other metric I would work on. But ultimately, the alignment for that came with the fact that I wanted revenue growth over profit. So revenue growth over profit. So my metrics going to be revenue generating metrics, going to be tied to new revenue, R&D revenue, revenue from updates to existing product. My expectations, I'm going to drive compensation plans. I'm going to drive commission structures, bonus structures, tie back to the expectations I'm looking for. So since I'm driving those bonus structures, how I identify 29% is, and it's funny to say, but you do look at some trailing indicators. The first thing I knew is that in general, I had a certain understanding of my margin, my gross margin, so my cost of delivery. Then second, I had an expectation for profit that I had. And so in monitoring that, you can see very quickly the adjustments that would happen if I went over or under that 29%. So I identified it by looking at some trailing indicators for sure. But I had to consistently look at future opportunities, especially trends from competitors and market trends to bring in new product, because if I didn't bring in that new product, that revenue growth wouldn't happen, and that percentage would always be 30 or above. And that each time it was 30 or above, we were losing money. Even at a high revenue, even in a high revenue month, it didn't matter if revenue was low or high. If I had a high revenue month, but that number was above 30, we were still losing money. Of course, probably had to spend a lot of marketing money to get there. That's that balance that you have to be. So there are trailers that help, but I can't fixate on all the other trailers, like what is the marketing cost of this specific product and what's the gross margin of that specific product. You want to be transparent in your communications. I had my practices. Hey, I want 4 web seminars a month. I want 3 new classes a month. I want this amount of content generated this month. I'm looking for this many web hits. So I'm looking at these practices. How are these practices? Are we practicing testing new products? And are we amplifying the ability to market those new products? Are we amplifying our ability to get out there with messaging new potential outcomes? So that alignment. Are you profit? Are you revenue? How much growth revenue are you looking at? Core metrics that help you drive that you can watch. But tying, here it is, any way that you can tie compensation specifically in alignment with what you're trying to achieve is very powerful. Then if you're doing this, constantly getting updates associated where we are with regard to revenue or where we are regarding margin. This is a big one. So if I'm going to bonus people on revenue, I got to let them know what the revenue number is. I got to let them know what the revenue is actual versus plan, where we need to go, or else the number is useless. If if I have a quarterly number and we're going to be off, and I'm not telling people in October that quarterly number is off, then how are they going to know what to do and how to do it? Well, they should be doing that. No, we're human beings. You have to instill a level of consistent communication with human beings as it relates to trying to achieve certain outcomes. And the thing I love about this slide, and this is the last slide, is it's very similar to the 5 levels of planning in Agile. But the problem for me is I wouldn't necessarily think that organizational-wide strategies and goals. I'm looking at strategies and goals at the U.S. department level, even though we're small, in 6-month increments. And I'm looking at changing approaches every 3 to 6 months these days. And I'm trying to push capacity every month as it relates to the things I need, trying to push for some overcapacity where possible in a lean way. Getting down to the daily, we meet daily. I look at numbers daily. We meet weekly to overview those numbers. If we have to, we might meet monthly to go over some of the approaches and the processes, what's working and what's not working. So from this slide perspective, I would tell you that you need to be spending more time looking at your approaches on a consistent basis, and you need more time evaluating your strategies and making sure those strategies are in alignment with what the market is willing to give you right now. So, got into a lot. I think goes deep into maybe some of the core metrics that an agilist will work on. I really wanted to get deeper into some of the mindsets, some of the logic, the thought associated with it, show you a couple practical examples of things that are occurring. With me on the internal side, I really would not mess with internal core functions unless it was absolutely necessary to bring a pop as it relates to maximizing efficiency and capabilities. That's just was my strategy. I'd rather create APIs that could pull into different disparate systems initially before trying to replace. But there are avenues internally where that replace strategy becomes an important part of the overall portfolio. Any questions, thoughts, comments, ideas? Anything anyone else would like to add? All right, then. With that said, have a fantastic rest of your day. Appreciate all the feedback and support and ideas thrown out there. Thank you so much.